For over a year, investors have enjoyed a rally for the ages. Since hitting the bear market bottom on March 23, 2020, the major indices have gained from 83% to over 100% through April 26th. Right now, it's awesome in the land of forever upward equities. The Fed has pledged to keep lending rates at or near historic lows for years. Meanwhile, Washington seems to be handing out trillion-dollar spending packages like candy on Halloween. Could we be in one of the strongest growth periods for the U.S. economy? For all you Cinderella investors, history tells a different story, and you might not like this tale. So, let's take a look. As you all know well, it's impossible to precisely pick when a stock market crash will occur. Regardless, stock market history is pretty clear when certain benchmarks are hit. Although the market doesn't repeat history exactly, at times it can be like looking into a mirror. One of the major telltale signs of an upcoming crash has been the Shiller price-to-earnings ratio. And this is also known as the cyclically adjusted PE ratio or the CAPE ratio. And as we've talked about in previous videos, the S&P 500 Shiller PE is a measure of average inflation adjusted earnings from the previous 10 years. With the near daily closing highs, the Shiller PE ratio stands today at 37.53, and that's over double the average Shiller PE of about 16.81, which goes all the way back to 1870. But the current level of the measure is not the scary part. The scary part is that a level over 30 has only been reached 5 times since 1870 in a continuous bull market. And in each of the previous 4 times, the S&P 500 declined from 20% to 89% from the peak. 89% may not be in the cards for us, but 20%, that's a possibility. History also gives us a great look at what happens following a bear market decline. Since 1960, there have been 9 bear markets. In each of the previous 8, there were at least one crash or correction within 3 years of reaching the bear market bottom. What this means is there's 1 or 2 sizable downturns following every bear market. And if you're keeping track, it's been more than 13 months since the S&P 500's bear market bottom, and we haven't seen a double-digit decline in the index. And it's also good to keep in mind that the S&P 500 has experienced a 10% or greater decline about once every 2 years. Actually, it's about once less than every 2 years. No, the stock market will not follow the script, but these are the possibilities that become more probable. An interesting statistic that often gets overlooked about stock market crashes and corrections is how quickly the crash or correction occurs. Out of 38 double-digit declines in the S&P 500 since the beginning of 1950, 24 of these have been resolved within 104 or fewer calendar days. That's about 3.5 months. Another 7 found their support somewhere from about 157 to 288 calendar days, or about 5 to 10 months. That means just 7 double-digit declines in 71 years took more than a year to find a bottom. But even more important for investors is that history tells us that crashes and corrections are great buying opportunities. And in every case, the decline was eventually put into the rear view mirror by a bull market rally. So, when a bear market comes, where can investors find protection? I'll have an answer to that soon. And for today, that's ChewDog Charts. Thank you.